This week on the Retirement Quick Tips podcast, I'm recapping the third quarter of 2024 and the markets and the economy and looking ahead to the end of the year, and especially with today's topic, looking into next year, because I'm talking about what the outlook is for the fourth quarter as we kind of round third base and head for home, and looking at some of the investment opportunities. I already touched on this yesterday, but it bears repeating, and that is lock in rates. So in an environment where the Fed is cutting interest rates, which they just started to do and they're expected to continue to do into next year and beyond, we want to get out of short-term CDs, short-term bonds, money markets, cash, get out of those and lock in rates for a longer period of time. If you think about it, if you have a one-year CD right now, and let's say you bought it a year ago, so it's about to mature. Well, you were probably getting, if you bought that CD a year ago, you were probably getting like 5, maybe 5.25, a really good rate. If you turn around and buy that same one-year CD today, you're not going to get that. You're probably going to get somewhere in the range of 4.5, maybe if you're lucky, a little bit more than that. So you can see rates have already started to come down. So if all of your bonds are shorter term and they're going to be maturing and continuing to mature over the next 12 to 18 months, you're going to reinvest at much lower rates as this Fed rate cutting cycle continues. So now is the time to lock in rates. Go out and buy a 5-year bond. Yeah, you're going to get less interest than what you could earn even on a shorter term bond in some of those cases, but at least you have that money locked in for the next few years. And so I'm not saying go out and buy a 30-year bond, but what I'm talking about here is generally extending maturities because it gives you an opportunity to lock in rates. So I've been pretty aggressive in doing this with clients where we have money markets, we have short-term bonds, extending that out and buying bonds that mature in 3, 4, 5, 6, 7 years. And I've been very hesitant to do that up until now. But when you look, just let history be your guide. In an environment where the Fed is cutting interest rates, the best thing that you could do is take advantage of that lock-in rates. And there's no reason to believe that they're going to turn around and start raising rates again. So you want to be flexible with this, but with fixed income, you can be flexible. You can shift strategies and change as the winds change with what the Fed is doing. So there's an old adage, don't fight the Fed. And that definitely applies in a rate cutting environment where they're lowering interest rates back down. That's the main takeaway in the bond market. Moving on to the stock market. The thing I want to emphasize where the opportunity is and looking ahead is that we are at pretty much an all-time high in the stock market right now. And the biggest thing that you could do to have an impact long-term on the returns is to not be complacent. So the time to rebalance your portfolio is when it's at the top. Now, I don't know. It could continue. And it seems like the stock market, barring some external strange curveball or shock, is going to end the year in a good spot. It could go higher. Yeah, it could go higher in 2025 and beyond from here. But don't miss the opportunity to rebalance and reduce your risk, because the concern that I have is that we've had a pretty strong stock market now for the last several years. And if you haven't taken steps to rebalance and take some money off the table, and it's a hard time to do it because you're like, why would I move money out of stocks and into bonds when my stocks are doing really well? You might be up 10, 15% or more for the year. And why would you want to move out of that into the slow moving lane of traffic, which is bonds? Well, the reason is to reduce your risk. I was just having this conversation with a client today. If you are invested, say 70 or 80% in stocks, but you should be like 60% in stocks, that difference in having a much higher allocation, depending on your portfolio value, is a huge difference in terms of losses. So for example, if you have $1 million portfolio and you're 80% in stocks, that's $800,000 of your $1 million portfolio that's in stocks. in the next market downturn, recession, even just a garden variety recession, you could expect that portfolio to drop anywhere from 20 to 25%. So you do the math on that. A 20% drop, if I'm doing my head math right, is about $160,000 gone from your $1 million portfolio. Okay, so if you're in 60% stocks instead, the returns are more muted. So yes, you would still lose money, but you're going to lose a lot less than if you were 80% in stocks. So the time to rebalance is when you're at the all-time high and you're not giving up a lot. It's not like 5 years ago when rates were at zero and you're moving into bonds where it's not making any money. You can actually make money in bonds now. So in the last 17 years now that I've been a financial advisor, it has never been a better opportunity to rebalance when the market's at an all-time high and bonds are paying much better than they have historically. And in a rate cutting environment by the Fed, if you look historically over 3, 6, 9 months after the Fed starts cutting rates, bonds actually outperform the stock market. So there's, I think, tremendous opportunity to be investing in bonds right now and rebalancing. So I think that's the main investment opportunity. I'm going on a little bit long. I could talk about other areas as well, and I'll save the election discussion. I've been teasing this all week, but I've had a hard time fitting it in, and I meant to do it today, but I've gone a little long. So I'll cover that in tomorrow's recap episode and how the election might drive the markets for better or for worse in the fourth quarter of this year. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.